The Speculative Sentiment Index is designed to help you trade trending currency pairs. The index is published twice a day, and the most recent articles appear at the top of the list. The index is designed to give a directional bias to your trading. For example, is it better to buy or sell? That question can be answered by analyzing the index ratios. An index ratio tells you whether traders are net long or short a particular currency pair, and to what degree. If there are more traders long than short, the ratio is positive. If there are more traders short than long, the ratio is negative. From this article, you can see that there are 6.92 traders long the dollar-yen for every trader that is short, and that there's 3.73 traders short the Kiwi dollar for every trader that is long. Now, what should you look for in this data? We recommend following two simple rules when locating a directional bias. First, locate ratios that are 1.5 or greater, or ratios that are negative 1.5 or less. Then, for ratios above 1.5, locate pairs whose ratios have been increasing over the past few days or weeks. These are going to be more reliable than those that have been decreasing. For ratios below negative 1.5, locate pairs that have been decreasing. These are going to be more reliable than those that have been increasing. The detailed descriptions at the bottom of this article provide additional information explaining how the ratios have changed over time, which is helpful. The currency spotlight is where DailyFX highlights a pair they want to draw attention to, so you may want to pay special attention to this section as well. Now let's say that you find a pair that follows both rules. What do you do with the information? The Speculative Sentiment Index is a contrarian indicator. So if you find a pair that's heavily weighted on the buy side, with more and more buyers coming into the market, the directional bias of the index is actually to sell. Alternatively, if the pair is heavily weighted on the sell side, with more and more sellers entering the market, the directional bias of the index is to buy. And here's why. Forex trading crowds tend to fade momentum. Most often, we see the majority of traders sell into rallies and buy into declines. During trending market conditions, this means that we use the index as a purely contrarian indicator. If the majority of traders are short, then we would expect price to continue rallying. If the majority of traders are long, then we would expect price to continue falling.